Hello everyone, welcome to this special video which we are shooting today. This is based on a Twitter thread and a video which all of us must have seen yesterday. And this Twitter thread was by Kiru from Chennai. And I'm sure everyone has always felt it as well as read it at many places that India is the largest, has the largest turnover in options in the world. And no one had the data, but yesterday it was a huge eye opener, at least for me, when he presented the data. And that's why I asked him whether we can shoot a video, because it's not just the presentation, there are other points which we also can discuss. So welcome Kiru, and thanks for accepting my request.
Hey, thanks so much, AP, for having me in this session. I'm really glad, to come online and to share my insights. And also, I quite, I found it really, insightful. Like yesterday, after posting the thread, I just gone for a walk, and by the time I came back, a lot many people shared, and those threads were, even people forwarded to me also. So I really find that, people find it useful, and really I'm glad for that. And no, even yeah, it's good that you are conducting a session on this, because lot many people are into option selling now. So it is good, this is a right time that we should make people aware about all the risk that is involved with respect to options trading. So I'm glad to be part of this session.
Yeah, so maybe you can go through each part first, and then we can discuss whenever we feel like on each point.
Yeah, sure. See, basically the idea of this thread, or the idea of writing about this option selling and the risk about option selling, came in, like, it's been there in everyone's mind. Like, if everybody are into option selling, what is the kind of risk that we might face? So this questions is there in everyone's mind, but in spite of that, everybody is still are into option selling. And also, if you observe the last 2 years, specifically after COVID and before COVID, like, for an example, I started trading in 2008, like almost 12-14 years before. When I started trading, it was like, initially I have to start with cash markets, where I buy shares, sell shares. I try to learn how the overall trading works, and then I slowly moved into futures, and then on to options buying, and then finally into option selling. So the last leg of every trader is used to be an option selling. That was the last part that most people will focus on. But currently, like for an example, after 2020, because of many people started getting into markets, and more people started directly trading with option selling, because they were able to see a lot many YouTubers posting videos about option selling, strategies about option selling. Back then, if you have to backtest any specific strategies, it takes a lot of time. We need to write a long code, we have to get the data, and doing a simple backtest itself is a huge task. But because of rise of no code platforms, now it is much easier to backtest any kind of trading strategies. So since there is no much entry barrier with respect to option selling, and also automating the same trades, lot many people started coming into option selling, and they were also making a consistent returns. Like, since most of them are trading straddles or strangles with a fixed stop losses, it is somehow making decent returns in the last couple of years. But in the last few weeks, after meeting a lot many traders who are into option selling, who are managing hundreds of crores, I thought, okay, probably this market is very concentrated. And I thought, just because I met few hundred people, I can't come to a conclusion that most people are into option selling, or option trading is crowded. So that is when I thought, okay, let me do a complete research, like how the overall market is looking like, and how many people are really into option selling, and how many contracts are being traded. So I started gathering all this information, and then came to know, okay, there is definitely some risk that is involved in the markets. So I started writing a detailed thread about it. So the basic idea is, just because we use a stop loss in any kind of option selling system, it is not really safer. So that is the whole idea behind writing such a big thread. Because people who started in 2020, or who started in just last 2 years, they might not be aware of multiple events which happened in the past. Even for an example, 2020 March, when the first crash happened, when first time market lockdown, went down in lower circuit. So that time there was not in a intraday leverage was not available with most of the brokers. Because of huge volatility, they sent out an email starting from zero. Every single broker sent out a notification in the morning itself that they are not going to allow intraday trades. So because of that, the damage was relatively lesser in 2020 lower circuit. And back then still the margin rules were not implemented, so we did not move completely to the the current margin structure where intraday margin and normal margin
I
came
just
in.
want to add something here. Like you rightly said, when you also started, you started with cash, then moved to futures, and finally, options buying, and finally options selling. That is the usual route which everyone takes. The same thing I have also done. In fact, starting from intraday cash trading. Nowadays, no one does intraday cash trading, but one of the reasons might be that the leverage has gone in cash trading. That is one possible reason, right?
That is also very true. Like back then 10x 20x leverage was there, and every single broker, the
Yes.
main way to acquire a client is to give them a leverage, because everybody is into the same pricing, everybody is charging 20 rupees. So the only way to acquire new clients is not through pricing anymore. So that is when they started giving huge leverage. And once that leverage was also taken out, then people started, okay, might be cash market is doesn't look much attractive
And
like a
another
gold
point
stock.
is you mentioned March 2020. That time it didn't create much damage because the margins required were high. And I'm not sure when it was done, but when they reduced the margins for hedged positions like spreads or something like that, are you aware when that was introduced?
I think by 2021, so they started doing it through phase by phase. So every 3 months they started increasing, like every quarter they started increasing. So instead of directly bringing in both intraday margin and normal margin as same, they it was done in a segregated way. So every 4 months once, the leverage started increasing. So
No,
earlier,
that's fine. I'm talking about lower margin required when you buy a protection. Like people buy a 10 rupee call or put and short the at the money call or put. So the margin reduces to almost 1/5.
right. That was implemented by end of 2021, I guess.
So maybe that is also one of the reasons why a lot of people are entering this selling part.
Yeah, that is true, because earlier that kind of margin facility was not introduced by SEBI, but after that particular reason, even the number of contracts that is being traded last year or even the current year, it could be much higher, because people started getting more and more trying to hedge their overall positions by buying more OTM options. So that could also increase the overall OTM. But people who used only specific to fixed stop losses, if they have done the same, and if the same 2020 repeated, I remember exactly, because in 2020 I was doing intraday trading, and I placed an order in the morning, and the stop loss was there. The moment market went into a lower circuit, all the stop loss order was cancelled, and market went into lower circuit. After the stop loss was cancelled, and within no few minutes the market again opened up, but it opened up and started moving up rapidly. So you did not even have time to place a stop loss again. So this is the kind of problem that we totally forget about. Like no people are hardly remember about that kind of incident. So if you are placing any, so many people think that the problem will not come with respect to intraday trading because I have stop loss in the system. But what if in case the stop loss itself gets cancelled? So most people assume only what if in case the broker goes down. But what if in case the whole exchange itself goes down? So that is how the hedging part will come. So that is where hedging will really help us out to exactly know what is the max risk in any kind of worst case scenario.
Yeah, in fact, there is one more thing. A lot of people, I mean, those days there used to be circuits for options itself, like 100% move from the previous day's close, or something like that. But if someone is short and has a stop loss just above the circuit level without even knowing that there is a circuit for the option, and if that
Right.
jumps, and when the market opens for that option again, it is already gone up so much that it will open well above his stop loss.
Right. Very true, very true. And also, as you rightly mentioned, even every strike has its own upper limit. So you won't be even able to place a stop loss beyond that limit. So it gets cancelled if you
Correct.
place it. So people has to be aware of that. And also this circuit keeps on changing as the market moves up. And as you know, like if there is any wild move that happens, so definitely we need to keep revising the stop loss. So if someone is doing an automated stuff, then these rules can be inbuilt. But if someone is not doing fully automated, and if he has to place the trades manually, so these are some risks that you need to keep aware, keep in mind when trying to design a system.
Okay, can you show the data now that we have already discussed the background?
Yeah, let me just open the data. So first, let me show you now the details wise. So the one that you're currently seeing now is actually, so what I started to do the research, I thought, okay, first let me find out what was the last 10 to 12 years of data with respect to index futures, stock futures, and index options. So first thing that I saw is index futures, where I could see the number of contracts that is being traded from the last 10 to 12 years, I could see there is a steady decline in futures contract. So earlier, I remember there used to be contract called even mini Nifty used to be there. So lot many people who did not have huge capital used to trade with mini Nifty, and that was removed, and only Nifty and Bank Nifty was there, and FinNifty was introduced only recently. So the overall number of futures contract currently we have almost three different indexes: Nifty, Bank Nifty, and FinNifty. In spite of that, still the number of contracts traded in futures is getting narrower and getting lower and lower year by year. And when I check the overall futures contract, stock futures contract, which has been traded in the last 10 to 12 years, that is almost stagnant. Like if there could be the number of stocks which is part of FNO could have been increased now. So that is why maybe last 5 or 6 years you are seeing a much higher number of future contracts, but there is no increase there also. It's
Yeah.
completely stagnant with respect to stock futures. And only when I checked further, and then when I started checking the option contracts, I was astonished by the overall data that option contracts is given. Like in last 12 years, as you could see, it is almost flat from 2009 or 10 to 2017 or 18. But after the introduction of weekly option by 2017 or 2016 June, that is when they started with weekly Bank Nifty options. And initial 2 years there was no traction, but as you could see from 2018, 19, 20, 21 it started going up, and 2022 and last 2 years it has seen a phenomenal increase. Initially I thought this is just a cumulative overall open interest, but this is not cumulative overall contracts. It is actually the number of contracts traded each year. So the number of contracts has significantly gone up in last 2 years, and even the growth wise, as you could see, the number of contracts which gets traded on a year on year basis, if you could see, this is the growth. As you could see, the last 2 years we have seen more than 125% growth in the options turnover and option contracts. This is huge. Like 2018 to 21, it's been almost stagnant. It's almost 75, 75, 75. And from 2021 and onwards, it's almost more than 100%, and it is increasing every year 100%.
So this is
So
not just about COVID, is it? Because COVID was, I mean, the rise is, the major rise is only in the last couple of years. So it's
exactly.
blaming it on COVID is might not be the correct thing.
Right. The COVID part, it could be because the more number of traders, like for an example, from 1995 to 2020, almost 4.5 crore demat account was there. And from 2020 to 2022, just next 2 years, additional 5 crores was there. So whatever the growth that we have seen in 25 years, we saw in the next 2 years because new people came into the markets. And no, definitely there was no major portion of those people started directly doing options trading. And as you rightly mentioned, after the SEBI margin rule, where if you buy spreads and have hedge positions, the overall margin gets reduced, right? And because of that, also the turnover could have been increased in the last 2 years.
I'll tell you one simple mistake which people make. I mean, especially the new traders who don't understand risk much. Let's say they say that I need 2 lakh rupees to short one lot of option, 2 lakh in the sense in trade allocated capital. And if can get 4 lots in a hedged position by buying a out of the money protection, then I can trade. Why not trade 5 lots? That is a absolute wrong way of calculating the position size, isn't it?
Exactly, because no, they don't check what would be the maximum drawdown. Say for an example, you trade with one lot, and if the maximum drawdown is say suppose 20,000, and you are trading with 2 lakhs per lot as a capital, then now if you are trading with only one lot, then with 2 lakhs of capital, 10% is your overall drawdown. So now
Correct.
people don't give too much importance about this maximum drawdown. All they see is, okay, I have 2 lakhs. What is the maximum number of contracts that I can trade? So they go and check this edge mechanism and see, okay, if I start adding 1,000 points away OTM options, instead of one lot I can trade with two lot. And if I bring in the hedge bit closer, instead of 2 lots I can trade with 4 lots. So
Yeah.
they concentrate on the number of lots that they wanted to trade and totally forget about the percentage of risk that they are going to take by increasing the overall leverage. And also the second part is, this week you might see, okay, the last 1,000 points away OTM options is 5 rupees or 2 rupees, but people assume, okay, it is going to be only 5 rupees, so every year if I keep doing this, probably I can increase my overall returns. But when the volatility increases, the same 1,000 points away OTM options which you saw 5 rupees today can go to 10 rupees, 15 rupees, or even 20 rupees. So your cost
Right.
also increases. So it's not stagnant. So people tend to assume that this is going to be stagnant. Okay, if it is 1,000 points away OTM options is 5 rupees today, they tend to assume that it is going to be 5 rupees forever. But when it increases, then at that point of time you would not be able to buy the hedge, and your position size keeps varying, because once the volatility increases, OTM option prices increases. So there is no fixed position sizing rules people follow. So that is totally, people take it for granted, and that also causes a very huge risk when market turns against them.
Another thing which I definitely can think of, I mean, I'm just looking at the possible reasons why it has shot up. Another reason is they, since the time they introduced physical settlement in stock options on expiry day, you cannot have ITM long options. So, is it possible? Has it happened that people have switched from stock options to index options because of that?
No, stock options is relatively lesser. Say if we have introduced weekly stock option expiry, then again you will see a massive shift with respect to stocks. Probably the top
Yes.
15 most liquid stocks, people will go with it. People are not going with stocks. Is mainly if I trade with monthly expiry, I have 12 trading expiries in a year. If I go with weekly, probably I have 52 different weeks.
Yeah.
And now they are looking for daily expiry also. So now we have Tuesday expiry with FinNifty and Thursday expiry with Bank Nifty. Soon there is one more expiry going to add on Friday. So 3 different weeks. So almost more than 150 expiries they are now trying to focus on in a year. So that is why the concentrated option selling is increasing. Even with respect to the same thing is happening with the US markets, where the zero
Yeah,
DT
zero
number of
DT. Yeah.
the number of the options which is expiring on intraday basis, on a 0 day basis, the contracts has increased exponentially there. And as you could see, after 2022, the number of people who are trading on specific to expiry days has increased exponentially. And so I thought this is happening only with Indian markets, but even with the US market also it is happening, where more number of people are specifically focusing on intraday expiry, which is going to trading on a specific to expiry days. And the best part is they have multiple expiries, so it is not like only Thursdays. They have expiries throughout the week, and also they have
Yeah.
expiries for stocks also, daily expiries for stocks also. So the concentration is really huge there.
Yeah, you can go ahead with your other
So that
slides. Yeah.
that is what I did. So after going through the data with respect to US markets and the number of contracts which is traded with respect to US markets, so I thought, okay, definitely, it is not only happening in Indian markets, even with respect to US market, it is happening. Where this is the last 10 years data that you are seeing with respect to short dated option contracts, where no percentage of listed S&P index options volume expiring within 24 hours. So the 0 day expiring, it has increased phenomenally in the last 2 years. So after 2020, 21 and 22, as you could see, it is increasing day by day. So almost 50% of the overall option turnover is coming from the expiry days with respect to US
Right.
markets. And also many people, starting from people with respect to JP Morgan and people from Goldman Sachs, everybody complained about it, and everybody is giving a warning that this is highly concentrated market, and where not only retail traders, even institutional traders are focusing and trading on these specific expiry options, and it is creating huge volumes. When such kind of concentration risk is there, this is directly linked to a liquidity risk. So when everybody is trying to exit the building, when fire starts, that is when the real panic will kick in. So people are dancing as long as the music is going on, but the moment music stopped, everybody will be rushing to exit. But we never know, like we know is definitely damage is going to be there, but the people who are properly hedged, they clearly know, okay, this is the maximum worst case scenario I'm going to face. There is one beautiful incident or beautiful article which I've read with respect to risk. This is from the book The Psychology of Money by Morgan Housel. So he has clearly explained about a specific risk, where risk is something which nobody thinks of. So during this World War time, what happened was, this German tanks and people were invading the other Russian places, and these German tanks, which is actually the most sophisticated technology that they have at that point of time. So the Germans are really good with respect to building tanks, building airplanes, and every military weapons. So they built this sophisticated weapons, and all they did was they took this huge tanks along with soldiers, and they went towards Russia to invade it. And it was a winter time, was the overall weather was not favorable to them. So they stopped all these tanks near to the Russian border, and they were waiting for this winter to cool off so that they can go and attack. So during this period, they halted all these tanks near a rice paddy field or some other field, and they halted there. At least they stayed there for 3 or 4 months. And then after they thought, okay, the weather is favorable for them, and they started, okay, let's start the operation again. Let's go and attack. At that time, when they started, when they're trying to start the tank, almost if there are 100 tanks, only 2 of the tank or 3 tanks are getting started. The rest of the tanks are not even getting started. So even the technician there who was trying to figure out what went wrong couldn't figure out exactly what was wrong with their tank. And they being one of the most best soldiers and best engineers, best mathematicians, every single guy were there in Germany who was trying to build these very good tools or very good weapons. They calculated every single thing, what would happen if there is an extreme weather. So they calculated that, and accordingly they built a tank. So what would happen if lot many people are attacking the tank at the same time? So they calculated that, and accordingly they built a tank. But one thing they forgot is none of this tank was starting because they kept all this tank for 2 or 3 months in a place in a paddy field where the field mice, all these mice, they went inside the tank and they eaten up all the electrical wires. So the total electric circuit was totally down, and because of that they couldn't start the tank. And obviously they would have not even think about an unknown enemy like mice which could come inside the tank, could eat away all these electric installations. If they have thought about it, they would have had some installations to cover all this part, but this is something they did not think of. So this is exactly what the risk is. So when we would be we'd be always prepared about it. We would think, okay, market, if it moves up within 1% or 2%, my stop loss is 30%, probably I'll come out of it. But we never thought of worst case scenarios. So all the worst case scenarios that people think is mostly on overnight positions. So what would happen if my overnight positions, I'm holding it, and tomorrow if market crashes, probably I need to hedge it. So they keep the hedge part there. But during intraday time frame, they don't think of it because they always think market is going to start at 9 o'clock and close at 3:30. In between, they assume that nothing is going to happen because the recency bias will kick in. So all the
So
traders who start,
people need to keep in mind that accidents can happen intraday also.
exactly. So if you look back the history of this US markets, which during this twin tower attack, the initial market opened, and when the first flight was attacked, market was open and it was trading. And when the second flight attacked, the market was stopped, and they did not open the market for next 15 days. So
Yes.
during an intraday time frame, your market is going, I mean, your positions are closed. Your positions are not even closed. Market is closed. But after 15 days, when it opened with a huge gap. So not only position traders were affected that particular time, even intraday traders were affected. So imagine you are in a situation like that where you hold intraday positions, and something very bad happens and market is closed, and next 2 weeks if the position is not open, imagine what if you are having a position size which is so huge. Like people lose sleep if just for overnight 1 day positions. They keep checking Dow Jones, they just keep checking what is going to happen with Singapore markets. Imagine you are doing that for next 15 days. So it is horrible, right? So every the market will be open and our markets is not open, and you will not be able to exit your positions. So these are the worst case scenarios which no one thinks about. So when before even you take a position, if you keep this worst case scenario and then accordingly trade, it's fine. But when you are putting all your money into the trading, and this is what your whole profession is going to be, and if you're specifically handling funds, managed funds, so a lot many pressure is going to be there. So if we don't consider all this worst case scenario, then it's very hard to come back up. It is definitely the moment you get into these worst case scenario and get trapped, we would not be even able to survive to take the next trade.
Yeah, so just to conclude this part about risk, you never know what will be the next mice in the Indian markets. I mean, like the example which you gave about the mice, no one knows whether what will come in the form of mice next. So I think is position sizing the only way out, or I mean, with proper hedge, of course. What is the way out, as per your opinion?
Yeah, that is see, you should clearly know about where. So until I finish this specific research and thread, I was also doing a simple system which did not use much hedge. Only for position I was using hedge, and whatever the intraday system I did not even hedge. So but now I know exactly, okay, if this is the worst case scenario, if I have an hedge, so what is the overall number of cost? For an example, you run a simple short straddle strategy, and you see overall my overall short strategy is giving me a 30% returns. Consider any kind of short straddle, even you consider this 920 short straddle strategy, which is going to give you 30% returns in a year. And then you check what is the average profit per trade. So for an example, if you calculate, okay, my average profit per trade is, say, suppose 20 points. So overall in the last 5 years or 6 years, your average profit per trade is 20 points. Now you find out what is the hedge cost. So if I'm buying 1,000 points away OTM options, probably I'm going to spend 5 points in it. So 20 points you are making in a selling, and 5 points you are losing in options hedging cost. So 15 points is a net you are making. So if you do this, what is the overall drawdown? And if this is done, even the worst case scenario is counted in. So if market gaps down 10%, 20%, or if it goes down 25% or 30%, or even if VIX shorts up more than 100, so you exactly know what is your overall worst case scenarios, your value at risk, exactly. So you need to find out what is your average profit per trade based on your option selling system, and see how much you are willing to let go of those points in order to hedge your positions. So if it is 1,000 points away, probably you are going to spend 5 points or 6 points to hedge. If it is probably 500 points away, then you will be spending little more. So find out your hedge cost on a yearly basis and see if you are willing to spend that. And so this is definitely going to bring down your overall returns, but you can also, not only it can bring down your overall returns, it totally controls your overall risk. So based on your strategy, you need to find out what is your risk per trade, profit per trade, and accordingly calculate which is suitable for you, whether 1,000 points away OTM options is suitable or 500 points away OTM is suitable. So when you add this edge into your system, make sure that it is not eating away all your profits. So there are people who
Yeah,
trade with very, very minimal
right.
risk. So when they do that, so obviously the profit points per trade might be going down very lower. So probably it will eat away all their profits. So find out, the best thing is, if you are trading with a lesser number of trades, obviously the profit points per trade must be much higher, so it is easier to hedge. So it's totally depend upon the trade systems, or the trading systems which we follow. Yeah, and also many people like who are breakout traders, who are specifically trading on intraday breakouts or intraday trend following, we used to have the regular discussions like why market is not trending big time. Even during the last discussions, during the last options convention meet, we almost some 10 traders were sitting together and discussing about it. And when someone asked, like, when was Madan was the person, so Madan was asking us, when was the last time you saw more than 1.5% movement in an intraday time frame? So it
Yeah.
happened very rarely. So the same case happened during the low VIX regime during 2017. If you observe 2017, positionally it was a trending year, but during intraday time frame it was a very narrow range year, where hardly you have seen any kind of big breakout during that whole year. So similarly, in the last 2 years, the number of trending moves has gone down drastically. So I thought this is happening only in Indian markets, but even with respect to US markets, S&P index markets, Bloomberg published an article. So the chart that you see is nothing but the how many number of reversals that we have seen. So after 2008, after global financial crisis, last year is the one where we have seen highest number of reversals. So if market is moving in one-sided direction, suddenly people are arresting the further move by keeping the market delta neutral, or more option sellers could try to arrest the overall positions, maybe, which we are seeing most number of reversals. So reversals is also one of the key area which happens when there is high concentration of option sellers. So in my opinion, I thought that can also be a primary reason of not having high number of intraday trending moves during the recent years.
One more possible reason of the jump, I mean, the exponential rise in the turnover. How much of it would you believe it on the algo trading, which has picked up in the last couple of years?
See, algo trading, I'm not sure exactly, but with respect to with whomever the broker that I spoke to, so earlier during 2012 or 14, when I started doing algo trading, like hardly less than 5 brokers were giving API, and most brokers did not have even API. So most people were integrated with companies like Symphony FinTech, so third-party tools which they used to place orders. So I used companies like Symphony FinTech to place in orders. But now there are more than 30, 35 brokers who are giving this API, and like all the orders which most people are doing it, like platforms like us, even with respect to Square, or platforms like TradeTron, platform like Quantiplay, huge number of platforms are there. So with respect to growth, like year on year, like 5 or 6 years before and now, if you compare, definitely there is a huge increase in number of people who are trading through APIs. So there is definitely high concentration of orders that are going through this option sellings through these kind of no code platforms, because earlier you need to write a code to execute it. Now all these no code platforms helps you to place the orders. So people who don't know about coding, definitely they would opt for these kind of platforms to place or execute the trades. So with respect to broker wise, broker might say, okay, the overall transactions through API might be percentage wise will be very, very lesser, because most people are still manual traders. But with respect to the automated orders 5 years before and now, definitely it has gone up.
Another question which people have asked yesterday, in fact, I was also discussing this with Raghunath. One thing which came up is, one is what are the authorities doing? In fact, what they are doing is they are increasing the expiries. They are not doing anything to reduce the volume, isn't it?
Right. That is true. That is true. See, basically, that is also an institution which wants to increase the profitability. So I personally believe, why do people need to extend the trading hours? Extending the trading hours is obviously it is going to bring in more volumes. Even though they say, okay, it is going to help you to hedge the overnight risk. Our market closes at 3:30 and it opens at next day 9 o'clock. So you have a huge 16 hours window where no trading window is there. So if there are any overnight issue or overnight global event happens, people are unable to hedge it. So we are extending the trading hours. So that is, I would say, like, that is just to convincing. That is not a convincing answer. Basically, they wanted to increase the turnover, increase the volumes. So they don't want these market share to go to SGX, Nifty, or other international markets. So obviously they wanted to capture the market share. So instead of going leaving all these market share to other international companies, NSE wanted to attract it. So they are extending it. And the second part is increasing the expiry. They clearly know, even if you remember, FinNifty expiry was same as Bank Nifty and Nifty, and later they moved it to Tuesday. After they moved it to Tuesday, more people started trading FinNifty.
Right.
And the volumes increased exponentially. Even if you go and observe the number of contracts traded on Tuesdays, earlier it used to be Bank Nifty first, Nifty second, and then FinNifty. Now FinNifty is the top volume creator with respect to Tuesdays. So more than
Right.
Bank Nifty and Nifty, FinNifty is creating huge volumes. So obviously, by so soon they'll bring in some there will be one more expiry on Monday, one more expiry on Wednesday also. So that is what happening in the developed markets, right? So people will bring in those kind of things. But one good thing is, after this SEBI margin rule, where if you have this hedged positions bringing down the margin, it somehow will control the damage to a certain extent. Imagine if there is no such leverage curve is not there. For an example, earlier, remember during 2017 and 18, many brokers used to provide you leverage very high, like even with respect to 3,000 or 4,000, if you have, you can short one
Yeah.
lot. So that is a huge systematic risk. So if that was done during this COVID time, definitely a lot many brokers would have gone bust. But now that is
Yes.
completely removed. So there is risk will be there, but the extent which it's going to create a damage is somehow it's controlled. But people who don't even use the hedge, probably they need to start thinking about it.
So in a way, government is, I mean, setting up new, very posh expressways, but they have also a lot of safety limits on the expressways, and they are sort of giving us support because of these margins and all that. That people should not take undue risk, and going bust will be a bit more difficult than what it was maybe 5 years earlier.
Yeah, definitely. Because everybody clearly knows, the broker exactly knows what is overall risk at their book. So the moment it crosses a certain threshold, they're going to square off your overall positions. But imagine a situation like this crude oil went negative, right? So when crude oil
Yes.
went negative, every broker lost money. So even Zerodha
Yeah.
lost 300 crores in that. So Nathan mentioned that they have lost 300 crores because of that, because our market closed and international market was open and they couldn't even square off the positions, and it created a lot of damage. So a commodity market, which very few percentage of people trading, has witnessed something which nobody has witnessed in the entire world. So that is kind of a black swan event. So when the same thing is happening with respect to Indian markets, we never know what kind of black swan event we might face. But when that is happening, definitely there could be some damage. But to what extent, or how much damage it's going to cause, we never know. But that is pretty much is controlled now because of all this edge-based mechanism which the government has brought in. So some of the risk is controlled to a certain extent.
One last question I have. In fact, a lot of people will be wondering about it. We have been talking about option sellers all the way. What about option buyers? I mean, they are able to sell only because there are buyers, right? What is your view on that?
See, I would say it is more than option buyers and sellers. It is more of a market makers. See, with respect to
Right.
Indian markets, we don't have no any buying order flow mechanism. Like when a retail trader is trying to place an order, it is directly going to exchange. So in US, it goes to a specific market makers, and they provide this bid and ask and liquidities, and they make money from this order flow, as well as through this bid and ask they make money. With respect to Indian markets, it is going to exchange, and there are certain authorized market makers out there who provides liquidity. So not only with stocks, even with options, futures, every single instrument they are providing liquidity. And NSE or any exchanges who gives them this access to provide liquidity gives them incentives also. Since you are the market makers and since you are bringing in liquidity, you are actually taking certain risk. So we provide you certain incentives, like if you cross certain crores of threshold in turnover, we will provide you certain percentage in it. So these market makers make money by providing us liquidity. So whenever you are buying or trying to sell an options, it is not necessary that the other end is going to be an option buyer. It could be a market maker who's trying to provide liquidity. And how does this market maker will do is, for an example, if you are a call option buyer and I'm a call option seller, so I'm going to come and sell you this option. As a market maker, when you come and try to buy a call option and I'm trying to sell you a call option, so in this case I'm short on markets. So when I try to sell you the call option, I'm short on markets, so accordingly I have to buy the underlying to hedge my positions. So all these
Right.
market makers, what they do is they'll try to remove the risk from their book. So they always try to hedge their overall position. So it is not necessary that the other end has to be an option buyer. It can be a market maker also who is trying to hedge the overall positions. Yeah, and also this image, which I totally forgot to explain about. So this image is nothing but the number of contracts traded in index options across all markets, NSE, Korea, and CBOE, in all other markets. We know that India is being ranked high and is one of the largest derivative exchange in the world. But as you could see, compare the first position, the second position, it is almost India's 10
70
times
times.
bigger.
This is
Yeah,
crazy.
it is so high. Like earlier it used to be 700 and then 1800 and then 4300, and all these 3 years none of these exchanges, closely observe, if you all observe all the exchanges, there was no significant increase in the overall contracts traded. But in India, the contracts traded has increased exponentially, with respect to the other exchanges, Korean exchange or Chicago board of exchange. So it is so huge. So even though people like JP Morgan, Goldman Sachs are warning about the US traders about the concentration risk, it is actually should be the Indian traders who should be more worried about this kinds of concentration. But in India, you don't see any kind of people from JP Morgan or Goldman Sachs commenting about such kind of concentration risk. So this is, we retail traders have to be aware about what is actually happening with respect to the overall turnovers, overall contracts that is being traded. And we have to imagine, as I said earlier, we have to imagine the worst case scenario, and accordingly we have to plan our trades. So when that happens, probably suddenly all of a sudden we might see, overall the volumes in options might get dried up if there is one single black swan event. So the 2020 we somehow escaped, mainly because the intraday leverage was blocked and many brokers did not allow us to trade. Probably some other incident, when it happens, we have to be better prepared for it.
So I think this was a very interesting discussion. Just to conclude, what is your opinion? Is this a ticking time bomb waiting to explode?
And yeah, I would say, but no, I think much more many people who are trading with larger capital, who are trading with higher capital, they are able to somehow consider this worst case scenario. So I have seen people who are trading with higher capital, who are trading with lower capital. So the problem with the people who are trading with lower capital is, people with lower capital always want higher returns, and people with
Yeah.
higher capital, they always want lower drawdown. So because of this mindset, no, they always know, okay, this is the maximum risk that I'm going to take. And most number of traders who are trading with large capital, they somehow are able to hedge their position and trade it. But people who are with lower capital, they wanted to move their capital and make quick returns and then move to the next phase of having a higher capital. So because of that, the risk taken by people having a lower capital is much higher. So probably they
Correct.
also need to think about it and have to have a so instead of directly simply creating a strategies which is based on fixed stop losses, they have to think out of the box and start thinking, okay, beyond, so 920 is over now, so what is the other kind of strategies that we could create. And accordingly, like at any point of time, they should have this bar at their screen, okay, this is the maximum value at risk with respect to my position. So or even if there is any specific nuclear attack tomorrow, this is the maximum loss that I might face. So consider all the worst case scenarios and accordingly design your strategies. That will not only give you peace of mind, and when everybody is losing their money, and if you're not at all losing your money, say consider you're a fund manager and other people are making huge returns, forget about it. But the moment when the entire world is losing money, and if your portfolio is not at all losing money, then the entire world will come to you to give the fund. So it's all about not giving huge returns but giving them a lesser drawdown.
Yeah. So you can't get rich quick by being an option seller. It's better to be slow and steady and win the race.
Exactly.
So hope
Sure,
you
sure.
liked this video, and it was definitely an eye-opener yesterday when we went through all those statistics which were presented by Kiru, and it's a huge eye-opener definitely for people who are trading in options, because I'm sure there are a lot of such traders who had not even thought of this earlier, and they need to think about this position sizing, how much risk they are taking, how much drawdown they would have faced if under different conditions again. Because one thing which we did not mention is the VIX is out at very almost at pre-COVID lows. So it is very possible now that it can increase, and if that increases, whoever were trading in terms of looking at IVs and VIX over the last couple of years, now maybe the environment change, and then it might be a different scenario altogether. So you need to keep an eye on your position size and risk at all times, not just overnight. Maybe even for intraday, there might be an accident at any point. So keep your eyes and ears open. So thank you, and bye bye.
Yeah, thanks, AB. Thank you so much.